Hi, good evening, everyone. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you for joining the session tonight about market outlook, or the macro outlook, actually, better said. I'm joined tonight by our Group Chief Investment Officer, Stephanie. Thank you, Stephanie, for being here. And actually, she will do 98% of the talk. Don't worry. I'm just going to do a quick introduction. It'd be good if you guys have time to answer the question that Stephanie posed on this slide by scanning the QR code. Maybe I'll give another 30 seconds to do so, and then we can start. As I wait for that, maybe a couple of administrative topics. If you have any questions, feel free to use the Q&A button on Zoom to answer the question. There is a lot of participants tonight, so I can't guarantee that we're going to get to every question, but I'll do my best to select the kind of the topics that are kind of they get the most questions and pose those questions to Stephanie toward the end of the presentation. I think we can maybe move ahead. Stephanie, do you want to show the results, or you're going to do it later?
Yeah, I think we're going to do it later.
Okay.
So let's, should we start the presentation tonight?
Yes.
Okay.
Keep going.
So
as mentioned earlier, tonight is about looking forward mostly. But before we do that, let me spend a couple of minutes introducing StashAway for those of you that might not be 100% familiar with StashAway. As I mentioned, I'm the co-founder and CEO, and Stephanie is our Group Chief Investment Officer. Then Stephanie will do a little bit of a kind of a looking back, quick review to 2024, actually. I'm back, I'm 20 years behind. And then she will look forward to talk about, Fed as the new normal and think about how this affects portfolio positioning for 2025. Okay, so you can click forward, Stephanie. So first of all, let me kind of quickly introduce StashAway. We are a digital wealth manager live in 5 markets. We're in Singapore, Malaysia, Thailand, Hong Kong, and Dubai. And tonight there are clients and non-clients from all of these regions. We are licensed in each of these markets from the local regulators, MAS in Singapore, the Securities Commission in Malaysia, the SEC in Thailand, and so FSC in Hong Kong, and the DFFC in Dubai. And we've been operating for quite a bit of time. So we've been live in Singapore since July 2017. So it's been 7.5 years, while the other markets are a bit newer. We're backed by some very prominent institutions, including Sequoia Capital, a very large venture capital fund, including Fidelity, one of the largest asset managers in the world, including Hamilton Lane, one of the largest private market investors in the world. And obviously, we work with a few banks, the custodian banks, Citi, HSBC, DBS, to custodize the cash and assets of our clients. I'm not going to go through the list of accolades. Through our history, because we were in many instances the innovators. We were the first one to launch in Singapore, the first to launch in Malaysia. We were the first to launch cash management in a digital wealth platform. We have won a few accolades over time, but obviously what makes us proud is not really those accolades, but rather the fact that we have a lot of clients that have been with us for 7.5 years now and continuing to invest and continue to build in their wealth with us. Stephanie, if you can click forward, I just want to spend a couple of minutes on how we think about helping our clients. So StashAway is a digital-first service. So we would like to think that you can do everything by yourself on the app. And it's easy to use, it's intuitive, it explains concepts that sometimes might be difficult in as easy as possible manner. For those of you that might not be investment experts, you do not need to be an investment expert to use StashAway. For those of you that are investment experts, we try to give you as much depth as possible so that you understand exactly how we are investing in StashAway. And Stephanie tonight will kind of give you an example of that by explaining how we think about those things. While we are a digital-first platform, we think that whenever you need to speak to us, it should be extremely easy. And so, as you can see on the screenshots on this slide, there is a WhatsApp icon at the bottom of the app. If you click on that when you are on the app, you'll be able to chat with one of our live human being agents and we respond in less than an hour. We respond to calls in less than 8 seconds. We respond to emails in the same day. If you are an accredited investor in Singapore or a professional investor in Hong Kong, you also also an accredited investor in Dubai, you also have access to a wealth advisor that can help you think about your assets. Yeah, if you can click onward. Last thing I want to talk about is what we offer. I'm not going to go into too much detail, but what you see on the slide is everything we offer today. We think about it as kind of 4 different pillars. We have, cash management offering. We have what we call the core portfolios, thematic offering, and alternatives. The core portfolio is what we launch with, is where everybody should have 60, 70% of their assets. Is going to be also the core of Stephanie's kind of presentation tonight in the way we think about asset allocation. We have a few variations on that. We have the general investing powered by StashAway. This is our kind of a flagship set of 12 portfolios from low risk to high risk that use economic data to make asset allocation decision. This has been live now for 7.5 years. So it's been stress test, not just back tested, but also stress test in real time, for across COVID and and inflation, in kind of inflation spikes and across kind of multiple cycles. On top of the managed portfolio, we also have flexible portfolios where you can actually build your own asset allocation or simply pick one asset that you want to invest in, as well as the income investing, which is only live in Singapore. On cash, I'm not going to read through everything you see on the slide. The offer differs a little bit by country because obviously it needs to be currency specific. So in Singapore, you're going to have Singapore dollars products. In Malaysia, you're going to have a ringgit product, for example. One thing we have everywhere is the US dollar cash yield, which enables people to have kind of a very cost-effective exposure to a US dollar cash. I'm going to skip thematics. I think that's self-explanatory, and briefly speak about our alternatives offer. For accredited investors in Singapore, we offer everything you see on the slide. So private credit, private equity, venture capital, angel investing, and crypto access. In Dubai and Hong Kong, we offer private credit access, and over time, we'll actually extend some of this offering to all of the countries. I guess the logic here is helping all of our clients build their wealth in one platform for the long term. We are not promising that you're going to double your money tomorrow. We're promising that we are helping you do the right thing. Invest over time, accumulate over time, make sure you keep your investing costs in checks, because that actually will accumulate and give you more returns over the long term. Now, done with my introduction. Stephanie, why don't we go through the real meat of tonight's session?
Sure. Thanks, Michele, and thank you everyone for dialing in. I know you have plenty of choices of how you spent your night. So Michele and I are very, very grateful that you chose to spend your night with us. Hopefully all of you will be able to bring home like some new insights and some new thoughts about how to invest in a new year. And of course, Happy New Year to all of you. And also because Chinese New Year this year is actually quite early. So a very, very early 恭喜发财, 恭喜发财 to all those that are celebrating Chinese New Year. So without further ado, let me start our presentation tonight. And as Michele mentioned, we're going to first take a quick look at 2024 and more specifically, what kind of surprises 2024 has brought. So I think before we do that, I'd actually like to kind of get some help from all of you. And I think it makes sense for us to kind of take a pause and review what we thought was kind of some of the asset classes that affected us most. So the first question of the night is here. Where did you invest most of your cash in 2024? And perhaps I'll let all of you to spend a few minutes maybe to scan the QR code here. And that should take you to our Slido page where you will be able to vote. So I'll just give a quick kind of 30 seconds or 1 minute for you to scan the code, and I'll put up the Slido link. So we have 5 choices: equities, bonds, crypto, fixed deposit, and then lastly, you basically mostly just kept your cash in the bank. And of course, if any of you have technical problems pulling that up, I think our team is here to help as well. So perhaps I think everyone had enough time to scan the QR code. Um, and let me just pull up the, the link. Okay, in a minute, I'll be able to share it. And I think I see results coming in. So let's see. I think equities seems to be leading the pack. We've got some bright spots in terms of course, like fixed deposit. And then we have crypto. Some people have actually put in, okay, fixed deposit is actually gaining in terms of allocations almost as big as equities. So let's see.
We
But I
did, we
think,
did we did see the fixed deposits in our numbers with a lot of our clients in Singapore investing in Simple Guaranteed, which is our fixed
yes,
deposit product. So we did see
yes,
that in 2024.
yes. So, but I'm actually also happy to see that equities is actually making up a big proportion because equities, of course, like had better returns than fixed deposits in 2024. So our investors here tonight are actually able to capture some of the upside. So I think I mean that kind of shows that I mean I think also fixed deposits crypto is actually leading as well. Wow. All right. So thank you so much for your participation. Actually maybe I'll just revert back to my presentation. We'll have more of this slide coming up, so don't worry. You get plenty of chances to vote again. So let me switch back. Okay, so I promise you I'll show you some of the surprises that we saw in 2024, and we actually proved through a lot of things that happened in 2024, and we thought I mean this is kind of our top five list of things that surprised us and perhaps I mean surprised you as well. Why do we think it's important to kind of look back? Because I mean when we try to come up with our outlooks, of course we try the best to think about what are some of the things that would have that could have happened that could happen in the next 12 months. But of course, a lot of times unexpected events happen. And so we need to be prepared for the unexpected. And I think it helps us to kind of put us in the right frame of mind to think about, I mean, what happened in 2024 that surprised us to get us more prepared for the next 12 months. So without further ado, first on the list is actually federal interest rates. Now, as we all know, the Fed actually cut interest rates in 2024. And I think if you think back at the beginning of the year, throughout the year, markets' expectation for how much the Fed would actually cut changed quite a bit. So if you remember kind of earlier in the year when there was recession fear, there were some estimates that put the number of rate cuts to be 7 to 8 times. And then fast forward to third quarter, when the growth numbers were actually strengthening, the market started to price in no rate cuts. Now, of course, at the end of the year, the Fed actually cut 100 basis points in terms of interest rates, and this is shown in the sort of the golden the brown line here. You see on the right hand side, the federal interest rates did come down towards the end of 2024. Now, we think that the Fed having cut interest rates was actually not the surprise. The real surprise to us was that despite the Fed having cut interest rates, actually, if you look at the yield on the long-dated Treasury, the 10-year Treasury, that yield has actually gone up. And the 10-year Treasury is actually depicted here as the blue line. So as you can see on the right-hand side in 2024, the blue line actually went up while the Fed was actually cutting interest rates. So indeed, financial conditions actually tightened despite the Fed lowering interest rates. This is actually quite unusual because, for example, if you look at the last rate cutting cycle, which was in 2019, 2020, both the US Treasury and also the US federal funds rate came down in unison. And this, of course, has implications for a lot of different asset classes, fixed income, even equities, because the US interest rates sets basically the risk-free rates for most asset classes. So it kind of forms the basis on which other asset classes are priced. So this was, to us, the first kind of surprise in 2024. Now, the second surprise was actually in this chart. So in this chart, we show the performance of four basic asset classes. Gold, of course, in yellow color, followed by equities in blue, and then there's a very, very kind of flat line or straight line, that's cash. And at the bottom, that's a bond. These are kind of return numbers for 2024. So I think if you look at these lines, it's very, very clear that gold has outperformed both equities and bonds, and also just kind of short-dated interest rates. What surprised us was that actually at the beginning of the year there were some fears about recession. Now the recession actually never came. So and at the time, what we said was basically when we look at the growth number coming out from the US, we thought that they would remain quite strong. So the concern on recession was actually overblown. And also because in an inflationary growth environment, we would favor gold. So we actually also added gold to our allocation. But the surprising thing was that typically gold would actually perform very, very well and outperform equities if there are fears in terms of a recessionary slowdown. That didn't happen, but yet gold has outperformed. So this to us was the second surprise. Now we'll go into why in a later slide, but just kind of keep that in mind. And then the third surprise was, I mean, we went through a US recession and of course, election. And of course, Donald Trump won and he has been inaugurated and got into office as of yesterday, right? I mean, the surprise to us was not that Donald Trump has won, but I think the market and ourselves were surprised by how the Republican Party has been able to kind of take control of not just the presidency, but also the House and the Senate. And also, of course, the sort of bromance between Trump and Elon Musk, and I guess all the kind of narratives around Doge and cutting government spending, etc. So that, I think, was a surprise to the market. Coming up to the fourth surprise, Bitcoin, and a lot of you voted for crypto at the Slido vote. That's where you kind of put a lot of your money. And I think for those that put money into crypto, you would have had a very, very enjoyable, good year. Now, I think the surprise here is not just that the fact that Bitcoin prices reached 100K within kind of a year of the ETF launch in the US, specifically the spot ETF launch in the US. But I think more surprisingly, or kind of to us, is if you look at the right-hand side chart, this compares the asset under management for IBIT, which is BlackRock's Bitcoin ETF, the largest kind of ETF with assets under management, versus GLD, which is the gold ETF, the biggest gold ETF that is managed by State Street. I mean, both are listed in the US, and GLD, of course, has been existing for a much longer time horizon than Bitcoin. However, if you look at the asset under management, Bitcoin ETF have been climbing very, very quickly. And today, actually, IBIT is not too far away in terms of AUM compared to GLD gold, which is an asset class that has existed for decades. So, I mean, this to us shows that there is significant institutional interest in the asset class. And I think that is a surprising fact. Lastly, bringing things a bit closer to home, Chinese stocks. And here, the surprise is, of course, at the beginning of the year, a lot of investors, especially foreign investors, were calling for a sustained bear market in China. And to a certain extent, I mean, people were saying that China is uninvestable. I think throughout the last year, I mean, StashAway has maintained, or ERAA portfolios have maintained a market weight to Chinese equities, given that, I mean, things are actually quite cheap. However, there was no kind of, I guess, we didn't see a strong kind of return to growth in our data. If you look at this chart here, actually, I mean, these 5 lines represent different markets, and the red line represents Chinese equity return. And if you compare China versus kind of MSCI All World or the US, I mean, China actually came in a second to US equity return. So US returned 25%. I mean, China was actually in a bull market as defined by 20% return. However, it didn't feel like a bull market, right? It actually felt like a bear market because most of the returns were actually very, very focused in about 8 weeks. So the first kind of burst of return happened in May, with the second burst of return happening in September, and both of which kind of was caused by, I guess, excitement around potential policies. And I think to a lot of people, that was actually quite surprising. But I think one lesson that we can draw from this is also that to reap the benefit of asset market returns, I mean, you need to stay invested. Because I guess even though Chinese equity had a bull market, if you didn't stay invested throughout May and October, you wouldn't have enjoyed that benefit. And it was very, very hard to time, I mean, when the market would have bottomed. So that was a surprise that is kind of closer to us in terms of distance, geographical distance. So throughout all these different kind of ups and downs and market surprises, I'm happy to report that actually, I mean, our flagship general investing portfolios had posted solid absolute and relative performance. So on the left-hand side, you can see that you can see the absolute returns of our various SRI portfolios. So from the top is 6.5, which is our lowest risk option. And at the bottom is SRI 36, which is our most aggressive option. And in 2023 and 2024, these portfolios have returned kind of, I guess, mid to low single digits to double digits. And this is despite, I guess, if you think about in terms of asset classes, I mean, bonds have actually had negative returns. So I think for our lower risk portfolios in particular, our allocations into cash as well as gold has benefited the absolute performance of these portfolios. Also, on a relative basis, if you look at the right-hand side chart, I mean, this shows the StashAway general investing portfolio average return versus our benchmarks, which are in the dotted lines. So as you can see here, this is the comparison over the last 3 years. And in the past 3 years, we did go through kind of various market cycles. In 2022, it was a bear market, and our general investing portfolios have managed to have lower drawdowns than our benchmarks. And in the subsequent recovery in markets, we maintained that kind of outperformance, and our portfolios are up almost 30%, or actually slightly more than 30% from 2020 lows. So cumulatively, if we look across cycles in the past 3 years, we have outperformed our same risk benchmarks by 6.1 percentage points on average. So that was a very, very quick kind of recap of some of the surprises that we had in 2024 and how StashAway portfolios actually fared. Now, as we look forward to 2025, we have published our CIO Insight report, and the title of this report is actually "Fat is the New Normal." Before we go into what fat means and why we think that fat is the new normal, again, we like to do a quick poll. So this time we would like to ask about your forward-looking kind of predictions or assumptions. So the question is again on asset classes. And we'd like to ask all of you to vote on the asset class that you are most bullish on for 2025. So please scan this Slido code and enter the Slido poll. And again, the choices are, there are 5 asset classes that you can choose from, ranging from equities to bonds to crypto, real estate, as well as commodities. So again, I'll give everyone a moment to scan the QR code and enter the poll. And I'll see you on Slido. So I think everyone would have had a chance to scan. So let me just switch over. Actually, we'd like to give more time for everyone to vote. So I guess we'll actually come to the result later in the presentation. So let me actually go through our analysis and what we think before we present the answer for everyone. So again, the title of our outlook is called "Fat is the New Normal," and not just that. I mean, we want everyone to have like a very sumptuous year, but also, I mean, Fat represents three things that we think are going to be central in terms of how we think about investments and how we think about kind of thesis for allocation going forward, not just in the next year, but also kind of in the next few years. So the first one, F stands for fiscal policy. A actually stands for artificial intelligence, and then lastly, T stands for Trump policies. So let me actually walk you all through each one of these in more detail. So first of all, fiscal policy. Now, when we talk about fiscal policy, basically what we mean here is that governments are going to both increase their spending and also increase their debt. And I think if you look at kind of what has been happening or what has been driving investment returns since the great financial crisis, a lot of that has been focused, or a lot of focus has been on monetary policy, meaning what has the central bank been doing? Were they doing QE, QT? Were they kind of tightening liquidity, increasing interest rate, decreasing interest rate, etc.? And there was less focus on what governments were doing or were spending. We think that actually we're entering an era where government spending will influence the economy to a much greater degree than it used to be, and that monetary tightening or easing or monetary policy may start to actually take a less important seat. And this is one of the key charts that we think explains why. So this chart basically shows you the estimates on US debt as a percentage of GDP under some of the current Trump policy agendas. And you can see here that on the left-hand side, that's where US is today in terms of debt as a percentage of GDP. Today it stands at around 100%, and I mean, of course, it seems to be quite high, but compared to other economies, for example, Japan or some other European economies, actually, I mean, U.S. situation in terms of indebtedness is not too bad. However, if you look at the projection out for the next 10 years or so, given the current Trump policy agendas in terms of cutting taxes, etc., I mean, this number is actually expected to increase. And there are like different estimates based on what policies actually get enacted in reality. But then, I mean, the estimates actually ranges from 130% to 160% in about 10 years' time. So I think this is actually quite important because what does that mean? That means that number one, the government is going to spend more on economies, which is supportive of growth, but also when a government needs to spend and when its indebtedness actually increase, it means that its cost of borrowing will also increase. So if you think back in the first surprise that we had for 2024, in which basically what we said was, even though interest rates came down, the yield or the rate on US debt actually went up. And we think actually this is one of the reasons why. Because if you look forward, the US government will have to borrow more. And just think about it in terms of if you were to lend money to somebody and that person or that organization or that entity is going to be more and more indebted, of course, the interest rate that you request on lending that person the money is going to increase. And we think, I mean, this is one of the dynamics actually impacting US bonds and US treasuries going forward. So this is key, I guess, a very, very important distinction from central bank policies because, I mean, this basically also affects US interest rates, especially for the long-dated maturities. Now, we also think that this is not just a US phenomenon because if you look at this chart here, it basically shows you how globally different governments have increased their spending as well as level of debt pre and post-COVID. So we've actually done a comparison of the government spending and indebtedness, comparing that on the left-hand side. You can see that like 2015 to 2019, that's pre-COVID average. And in the middle column, 2025 to 2029 is kind of post-COVID estimates. And the difference is how much more they're going to spend, how much kind of more in deficit are these governments going to get. So of course, the redder the number, it means that these governments are going to be more indebted. And you can see that most global kind of large governments or large countries will have increased debt. Leading on the top is China, but you can also see France, Germany, etc. And also, I mean, recently there were much more kind of political support for increased government spending, even in European countries like France and Germany. So, I mean, we think that this is actually not just a US phenomenon, but this is actually a global, I guess, a move that's going to happen. So going on to the second letter, A, that stands for AI. And I think a lot of us have heard a lot about AI. I'm sure most of you or many of you have tested with different AI technologies and perhaps are fascinated by that. We think that actually a lot of the AI developments that have happened in the past 2 years are focused on, number one, developing the LLM models in terms of investing in infrastructure, in terms of investing in chips. And then also a lot of kind of projects were actually focused on experimentation. And there weren't as many kind of adoption in the workplace. We think that actually going forward, there's going to be a lot more adoption in the workplace, which would affect company margins and revenues directly. So in this chart, you can see something called the hype cycle that a technology research firm called Gartner put together, and they update this, I guess, on a regular basis. You can see that Gen AI is actually close to the peak. So does it mean that, I mean, this is already a bubble that is going to burst? I think if you look at AI, AI is much more than just about Gen AI. So even though Gen AI is already kind of past the peak of inflated expectations, if you look kind of across the spectrum of the hype cycle, you can see that there are other kind of AI technologies that are coming up. So for example, on the top, you can see that there's AI augmented software engineering. Now, I think this year, I mean, we're going to see a lot of applications in terms of generating code automatically. So that helps software companies to both increase their revenues, produce more products, and also potentially increase their margins. Because, I mean, they don't, with the same amount of coders, they can produce a lot more code. On the left-hand side, things that are still kind of on the rise are, for example, artificial general intelligence, and I think more interestingly, autonomous agents. When you look at agents, I mean, these are basically AI programs or kind of, I guess, chains of reasoning bots that can perform a full task on behalf of a human. So again, I mean, this is something that can be employed in the workplace, and I mean, this potentially can also boost productivity for a lot of corporates. So actually, I mean, we think that this year is a year when we see finally or the beginning of widespread adoption of AI technologies in the corporation. And also when I guess we look at surveys that ask CEOs whether or not AI has been adopted in the workplace, we can see that, for example, most CEOs, or over half of the CEOs, said that actually Gen AI has not been adopted in the workplace. So that's why, I mean, we see a lot of kind of, I guess, new developments in AI, but not very many companies are benefiting from it. However, if you look at next 12 months, you can see that this number has flipped. Close to 60% of CEOs, I mean, says that they expect Gen AI to improve the quality of their product and services. And if you, sorry, and actually, if you look at next 3 years at the bottom, I mean, that number actually rises to 70%. So as we kind of look at earnings and margins, I mean, we think that AI will start to show kind of more widespread benefit. And then lastly, T, of course, our beloved Mr. Donald Trump, who just got into office and delivered a lot of executive orders on his first day. This is actually a chart that we have shown before. when Trump got elected, and we analyzed all the kind of potential, I guess, policies that he has kind of campaigned on. We grouped them into 6 major kind of blocks. On the top are tax cuts, deregulation, and then tariff, immigration, defense, and energy. What we also did was we analyzed the impacts on growth and inflation. As you can see here, for example, I mean, tax cuts are beneficial for growth, but also could potentially support higher inflation. As we mentioned, I mean, fiscal stimulus could means that the U.S. get more indebted in the long term, and that's why basically that would support inflation as well. And then I guess on the other side, deregulation is positive for growth, but it's not as kind of impactful for inflation. There's been a lot of, I guess, concern on tariffs. What we said at the time was that, in November, when Trump got elected, was that we don't think actually tariff is as big as a concern as the market has put on, given that, number one, I mean, we've been through it before, right? 2016, also there was tariffs being imposed, and many countries have different ways to deal with it. For example, I guess one way to kind of counteract tariffs is actually to let the currency depreciate for the trading partners. And indeed, that's what we've seen in the last month, right? Chinese renminbi has been weak, and US dollar has been quite strong. And I think today, if you look at Trump's inauguration, there were, I guess, there were some mentioning of tariffs, but not a lot of like very, very kind of harsh details on day one. Immigration was actually what we said would be a bigger risk, and because we think that actually this is, of course, negative for growth, but it's also very, very bad for inflation. Given that if we look at how US inflation have come down, a lot of that has to do with imported labor. And of course, if US kind of impose stricter immigration rules on foreign labor, that would push up wage inflation, that would put more pressure in the labor market, particularly when the labor market is still very strong. And indeed, if we look at Trump's kind of speech, he did emphasize the border and immigration as one of the key things that he will tackle in the first 100 days. And then lastly, of course, like defense and energy kind of benefits different sectors in different ways. So all in all, we think that the more kind of, I guess, among all these 6 pillars, the more kind of impactful policies that we should be focused on are, number 1, tax cuts, number 2, deregulation, and then number 3, the risk of harsher immigration policies. And also one reason why we thought that tariff is less of a concern than immigration is because of this chart. So this chart basically shows you, it's a survey for US voters. And this survey actually asks them what are the issues, what are the top issues that they like to get resolved in the first 100 days of Trump's presidency. And on the top is inflation, which is not surprising. I think that's number 1 concern for a lot of US voters. But also immigration ranked second. So for a lot of people, actually the issue of kind of I guess illegal labor and also immigration is on top of the mind. If you look at the bottom, things that people are much more relaxed about actually is on implementation of the tariffs and of course like other regulations. So from this, actually we concluded that, I mean, it's more likely that Trump would tackle the things that are much more higher in the voters' mind, which are inflation and immigration. So we've looked at, I mean, where we think the key pillars of kind of, I guess, investment framework should be and where we think they're going. What about the consensus, right? What are already priced in? So, I mean, we've actually gone through a lot of the sell-side reports and market outlooks and looked at like what other people are saying. So this is a chart that sort of try to summarize the consensus view in a very, very kind of concise manner. I think if we start from the left-hand side, the consensus is mostly expecting no recession, but they're less optimistic on China and Europe growth revival. On inflation, there are kind of expectations generally on contained inflation, but slower rate cuts. Indeed, I mean, the market is now, I guess, pricing in two rate cuts in 2025. Of course, that expectation changes a lot. If one data print can actually change that expectation already. And then on AI, I think the market generally kind of is looking for that as a driver of productivity. And also the market is focused on the infrastructure investment that is needed for the AI revolution. On the right-hand side, generally, the market is positive on US and thinks that US exceptionalism could actually continue. On trade, I think there is a lot of concern about the trade and tariffs, and I think this is where we have like kind of an anti-consensus call, where we think that trade and tariff is something that is kind of much more overblown. And then lastly, the market is looking for broadening out of the equity market rally into other companies outside of Max 7, particularly in terms of like mid and small caps. So I think these are kind of where the market is positioned. Consensus is not always wrong, but we need to be aware of where consensus are and how things actually develop and change over time, and where things are already well priced. And I think the ERA framework always just tries to, monitor economic data in a real-time situation to adjust to changing macro regimes as we go through the year. And I think one of the first tests, or one of the risks that we could face in the next, few months is US Treasury interest rates. So as I've mentioned throughout the presentation, US Treasury interest rates are rising despite the Fed cutting interest rates. And also, I think if you look at this longer term chart, basically the US Treasury yield has been falling for the last kind of 20, 30 years. But started rebounding in the last 2 years. And I think one of the tests for the new Trump presidency and his team is actually if the US Treasury interest rate touches 5% again, how would they actually respond to that? Now, as I mentioned, US Treasury interest rate is seen as a risk-free rate. And when interest rates actually increases, that tightens liquidity and tightens monetary condition. And typically, this is not great for risky assets. So if US Treasury does test 5%, I think that could sort of trigger a correction in the equity market. And I think that is a test to the new incoming administration. Now, of course, at the end of the day, when we look at equities, it's more about earnings growth. So I think as long as the earnings growth picture is still robust, as long as growth is still robust, equities could still outperform bonds. But of course, when it touches that 5%, it's going to create some nervousness in the markets. So with all that, like, how do we actually position our 2025 portfolio to kind of go through the year? And here, again, I revert back to our ERA framework. For those who have been with us a long time, you're very, very familiar with the 4 quadrants in the ERA framework. But for those of you who are just joining us for the first time, I'll just spend a quick moment to explain what it is. So when I talk about ERA, basically it stands for ERAA, Economic Regime Asset Allocation. And ERA is the core systematic framework that we use as StashAway to determine our asset allocation under different macro conditions. So for example, if you look at general investing by StashAway, that is managed under the ERA framework. And as we all know, the economy actually goes through different cycles. And if you look at the chart here on the left bottom corner, you can see that there are arrows going through these different cycles. And the reason why we can rely on ERA to guide us in terms of asset allocation is because these cycles actually repeat themselves all the time. And indeed, they actually repeat themselves because of the policy changes and also responses to different macro environments. So if we start from top, good times. Good times is, of course, as the name suggests, is a phase where we have positive growth, but also low inflation. And this is the best time for risky assets like equities because companies are enjoying superior earnings growth. And as the economy starts to heat up, inflation starts to grow or inflation starts to rise as well, then you go from good times to inflationary growth. I mean, the economy is still quite good, right? It's companies are still having strong earnings. That's why it's not too bad for equities. However, it's not as good as good times because as margins increase, as inflation increase, I mean, the central bank will start to tighten interest rates or raise interest rates, and also corporate margins are under a bit more pressure. But I mean, even if you inflationary growth, I mean, basically, if you look at kind of the tilt of ERA, it still tilts towards more aggressive assets to try to generate returns. And indeed, I mean, this is where we are in terms of quadrants, right? We actually have been in inflationary growth since April 2024. Now, if you move to the bottom of these quadrants, then you can see, I mean, we've got a more defensive tilt in a recession and stagflation. And even if you don't follow the economic cycle closely, I think these two words would ring some negative sentiment already. And indeed, I mean, these are times when it gets tougher for equities to perform. And that's why, I mean, the focus is on using balancing assets to kind of to smooth out the volatility in equities and to be able to kind of stay invested throughout these more challenging periods. I mean, typically these challenging periods are shorter. And in a stagflation, this is when inflation is high but growth is low. And when we go into recession, that's when both inflation and growth are low. And this is in a recession, typically that's when bonds actually perform the best. So ERA asset allocation actually makes different, I guess, asset classes investments according to where we are in the cycle. So today we are in the inflationary growth cycle. So here is a demonstrative kind of allocation for our three SRI portfolios. SRI stands for StashAway Risk Index. I mean, this is how we think about the risk of our different portfolios. So we have 12 risk index. And I think the way to maybe interpret these numbers is basically the worst drawdown that you can have in a very, very, very adverse scenario. And indeed, I mean, the exact definition is that there's only 1% chance over a 12-month period that you would experience this drawdown. So for example, for a very, very aggressive portfolio, 36% means that there's only 1% chance that your 12-month drawdown will exceed 36%. So the reason why we have these numbers is because if you look at, I guess, most funds out there, or a lot of mutual funds, they would give you qualitative rankings, right? They would say, oh, are you aggressive or are you kind of, I guess, conservative? However, the problem is that Stephanie's aggressive may not be same as Michele's aggressive. So it's very hard for somebody to actually, I guess, accurately determine your risk level. And the way we've provided these numbers actually make it very, very precise. So to determine your risk level, basically you need to think about your risk appetite, of course, but also time horizon. But I mean, here are three different kind of risk points that we provide to our clients. We have 12 of them. I mean, here's just three to demonstrate. So on the left-hand side, you can see the allocations for SRI 6.5. There's a lot of colors, but I mean, in general, I mean, those that are in green are bond and bond-like assets. That includes also very, very short-dated government bonds, which are kind of cash equivalents. And then I guess on the top, you can see that there are these yellow colors. I mean, these are basically our gold allocations. So as I mentioned, in April 2024, we have officially included gold into our strategic asset allocation. So all the SRI portfolios would have gold in their allocations. And this is because when we look at the fiscal policy, when we look at the fiscal condition for the US going forward for the next 10 years, we think that actually just having bonds is not enough to protect your portfolios. And that's why we think having a bit of gold actually acts as a very good defensive asset to balance out that risk. Also, if you look at the SRI 36 portfolio, that's on the right-hand side. I mean, that is our most aggressive portfolio. And you can see that there's no bonds, but there's a lot of blue. These blues are different equity sub-asset classes. I mean, those would include US equity, different kind of sectors, and also global equities. And in the middle, SRI 22 is a mix of bond equities, gold, as well as short-dated, ultra short-dated cash equivalents. So as you can see here, all the SRI portfolios are very, very well diversified, globally invested portfolios. So with all that, I guess how is ERA kind of capturing the Fed themes? In terms of asset classes, ERA is overweight equities and gold, and ERA remains underweight bonds for the reasons that I've described. In terms of geography, ERA prefers, US over Europe, given that we think that Trump policies are actually beneficial for US growth, and also AI as a technology also benefits US over Europe. Continue to favor Japan and India. These are kind of domestic stories that we like, and then also they benefit from a global kind of strong economic cycle. ERA remains market weight on China. China is cheap. However, the data still do not suggest a strong kind of recovery to growth for China. And for us to invest in China, of course, we like to see stronger growth. And then lastly, on sector, ERA has broadening out of the US equity rally as one of the key themes. So there are allocations to cyclical sectors, including industrials and also equal weight S&P. And then also in terms of sectors that benefit from the Trump policies, ERA is actually overweight aerospace and defense. And then lastly, healthcare, ERA still have some exposure, but I guess compared to some of the other sectors that benefit from FAT, the benefit to healthcare is actually less clear. So I guess I'd like to maybe finish off the presentation with a few what we call investment truths, or just food for thought to share with everyone. So I think we've had 2 years of very, very good rally in markets, and not just S&P, but global markets in general. And one of the feedback that we've gotten from our investors, or one of the questions, is that, oh, everything is at all-time high. Should I still invest? Is it too late? And here you can see a chart that shows you the index, the US S&P 500 index in the last 10 years. And I've drawn a few kind of bubbles here. All these were equity rallies actually following an all-time high. So, for example, in 2017, following an all-time high, equities actually went on to post almost 40% return. Similarly, in, 2019, 2021, and most recently, 2024. So, a all-time high actually doesn't mean that you can't get all-time highs again. And indeed, a lot of all-time highs actually follow previous all-time highs. So I think having an all-time high is not a reason for not to invest. And secondly, if you actually invested at an all-time high and picked the wrong timing, it's not the end of the world. And here, if you look at this chart, it basically shows S&P returns, or the S&P index, going back all the way to the Great Financial Crisis. So, for an investor who was very, very unlucky to have invested at the all-time high of 2007 peak, of course, that investor would have had a 52% drawdown subsequently. However, if he or she had stayed invested today, that investor would have reaped a almost 3 times return on that very, very bad entry. So even if you had entered at all-time high and you had to sit through some near-term volatility, if your investment time horizon is actually long enough, the market would actually recover and help you to recover the mark-to-market volatility that you experience. So even if you had picked like the worst timing ever, it doesn't mean that it's the end of the world. So don't be afraid to invest at all-time highs. Those are 2 charts that I've shown before, and this time I've actually added this new chart, this new kind of investment truth. Of course, markets tend to go up from bottom left to top right over time. But it doesn't mean that there aren't corrections in between. And indeed, if you look at this chart, this shows you S&P index performance from 1982 to year 2000. That was a 20-year bull market for US equities. However, within this 20-year bull market, we've had a few shakeouts, right? You see that there were corrections that range from single digits to 33%. But I mean, it had recovered afterwards, and the U.S. equity market actually enjoyed a very, very long rally. The question is, can you actually enjoy this long rally even with these corrections? And the secret to be able to withstand these corrections, I think, are twofold. Number one is to understand your risk level before you invest. So, for example, the reason why we had these SRIs is to help people to stay invested during these corrections. And corrections will happen, and they do happen. And of course, in 2025, we would not be surprised if they happen as well. But if you know your risk level, then I mean you can sleep at night, right? And perhaps I mean if there are some money in the bank, instead of panicking when the correction happens, probably what you could have done is to say, okay, I mean the market has corrected, let's say, I don't know, 10%. My SRI is sort of performing as I expected. Maybe it's time to get in and take advantage of these corrections in a very, very long bull market. So that's number one. I think secondly is having a diversified portfolio of different asset classes. So for example, in the StashAway portfolio, you have equities, you have gold, you have some cash, you have some bond, and within equities, there are different types of equities. So that also helps you to kind of, I guess, stay invested through these market volatilities. For example, I mean, gold tends to perform better when equities is in correction. And also, I guess, if having globally diversified exposure to equities and different sectors, then I mean it lowers the risk of having very, very significant drawdowns in one particular sub asset class. So I guess the message is I think I mean we're in a long-term bull market, but I mean expect these corrections to happen as well. So here comes my last slide, and I just wanted to have a quick summary of what we talked about tonight. We talked quite a lot, so just I guess as a good wrap. Number one, in 2024, the U.S. economy actually remained quite resilient. Gold and equities were the top performing asset classes, while bond underperformed. And under this environment, I guess our portfolios posted relatively solid absolute and relative performance, and they continue to do kind of outperform the index since I guess in the past 3 years throughout the cycle. In this year and beyond, we see FAT as the paradigm that's shaping markets. Number one is a shift from monetary to fiscal expansion. Number two is, of course, the adoption of AI in the workplace. And then thirdly, Trump policies, and we're already starting to see it impacting markets. We think that given these three kind of driving forces, given our framework, I mean, these are good for growth, but also may keep inflation kind of higher for longer. And as such, we expect, I mean, currently ERAA is actually in inflationary growth, and we expect this regime to hold in the coming year. But of course, we monitor the data on a real-time basis. So I just want to say if things do change, I mean, we will adjust our allocations based on a systematic framework. And ERAA, of course, also continues to take a diversified approach, and we have captured some of these trends by overweighting equities and gold and underweight to bonds. I won't go into details, but I mean, our team is always here to provide much more detail. And also, you can find all the allocations to our portfolios in our mobile app, so you can see all the details there. Lastly, just to kind of, I guess, because Trump is getting into the office today, and we are into 4 years of Trump, I think one of the things that kind of characterized his last presidency was that there's a lot of news flow, but a lot of that is actually noise and not signals. By signals, I mean things that actually move the market. So as such way, the reason why we focus on data is because the headlines always would impact sentiment, would impact things in a very, very short term, but they don't necessarily translate into investment implications. And we think that ultimately it's the data that determines where investments should be allocated. So again, stay disciplined and stay invested, and choose your right risk level. So I guess, yeah, with that, that's the end of my formal presentation. And I guess we can open up for Q&A.
Yes, thank you, Stephanie. This was as interesting as usual. I appreciate that. I'm always amazed, but I'm always surprised by the charts on how time in the market, on top of being impossible, actually in the long term doesn't really matter. Every time I see the chart, I'm surprised, even if I've seen it 100 times. And so I think I always take home the idea that investing on a monthly basis, closing your eyes, is just the best strategy all the time. But I do have a lot of questions, and I spent some time as you were finishing up the presentation trying to organize them by topics.
Yes.
I can't promise I'm going to go through all of them just because we have a lot, but I'll do my best, I promise. So first of all, on US equities, there is a question from HS asking, will US equities correct in 2025? And if so, by how much? And then I have a kind of similar topic question saying, wow, how much higher can it go? This question was asked when you were showing kind of the bull markets, kind of the whole-time high compounding one on top of each other. So one question, I mean, obviously it's kind of the same question. One is 2025, is there a correction? How much? And the second one, oh, okay, how much can we go?
Okay. So I guess if we think about, just take a step back to think about what drives equities returns. It's basically two factors. Number one is what kind of earnings growth are companies delivering, and at what price are you paying for that earnings growth? And if you look at history, for example, S&P has generated kind of roughly 11-12% in total returns in the past 20-30 years. And you can actually break that down into a lot of that is actually earnings growth. Actually, most of that is earnings growth. I would say kind of maybe 7-8% of that is earnings growth. There's a bit of that 2-3% that's dividend, and then maybe 1 or 2% of that is valuation expansion. So if you look at kind of where consensus is expecting the S&P to deliver its earnings growth for 2025, that number currently stands at 15%. And I think it's reasonable to kind of expect the S&P over time to deliver sort of your low to mid double-digit return. Now, of course, during a year, a lot of things can swing around. And the swinging around, these corrections are mostly caused by valuation changes. One very good, common way to kind of measure valuation is actually the price to earnings ratio. So, for example, for the S&P, the PE ratio, the price to earnings ratio, is now 21 times, which is fairly high. I mean, it's not crazily high, but compared to kind of historical averages, that's quite high. So I think that if you think about I guess the chart that I had on the US Treasury interest rates getting close to 5%, I mean, that could potentially, for a trigger, if it touches 5%, that could potentially trigger a correction in the valuation for the S&P. If you look at this, the chart that I show in terms of I guess if I go back a few slides here, in a bull market, you can expect to see some corrections that are kind of around 10% to 20% happening maybe every 2 or 3 years. So I think if as investors, we need to kind of be psychologically prepared for these sort of kind of mid-teens correction throughout a bull market. And I think in 2025, I wouldn't be surprised that we see one of these. However, that doesn't mean the bull market is ending. Why? Because when we look at the earnings growth drivers, when we look at GDP growth, when we look at the US economy, is still very slow, is still very strong. So we don't see kind of the risk of a severe recession in the US economy. And during the recession is when you get these 30%, 50% drop. So I think as investors, of course, we have to think about these corrections, but I don't think we need to be over concerned, particularly if you're invested in a diversified portfolio.
Thank you. And so I guess, a lot of information, a lot of uncertainty, nobody knows what happens. Best stories, continue to invest, make sure the risk level is right, and invest through the ups and downs. And one thing I always tell people is, look, if your time frame is long enough, when the market, so let's say you are in your 30s or your 40s or your 50s, and you are simply building your retirement plan, and the markets go down, that's actually good news because you can buy on discount. So that's, it will bounce back, and over time you can buy on discount. I know this is very counterintuitive and very difficult to kind of internalize. And it's normal that you get a bit agitated when you see red in your account. But in reality, in the short-term market correction is good news. You can buy on discount. It's like if you go to the supermarket and everything is down 20%, you can buy more. And
exactly.
especially, and this is stuff you can keep for a long time, right? There's no expiration date on your stocks portfolio or your diversified portfolio. So you can keep it for 20 years. It will come back up. So anyways.
Yeah, I think one important point is what you mentioned is a diversified portfolio. Because the same cannot be said of stocks, right? There are certain stocks that would go bankrupt. There are certain stocks that never recover. But if you invested in a market, in an index, I mean, it always recover. Unless you think that, I mean, the world stops growing, which is, I think, which has never happened. I mean, human being with technology innovation, with productivity growth, it's always moved forward. So I think this is why equities would always give you positive return over a longer time frame. But again, I mean, the same cannot be said of single stocks.
Now I'm staying on the US equities or the equities topic. There is a couple of questions on sectors.
Yep.
Let me find them and read them verbatim. The first one is, what is StashAway 12 months view on US industrial, XLI, US healthcare, XLV, gold, GLD, and SLV, which I actually don't know what it is. And connected to this, there is a question on would the US leaving the WHO have impact on healthcare sector, kind of connected to the healthcare sector question. And lastly, sorry, give me 1 second. I need to find it. I miss your, so Fai is asking, I miss your rationale for paring back healthcare.
Yes.
Should not increase our exposure given the pullback last year, given long-term outlook is healthy. So
yeah,
this is just a sector.
Okay, sure. So as a teaser, I mean, we're actually, I guess, last 2 weeks, myself and my team have been working very hard on the next Seattle Insight, which is going to talk about our views on the sectors in 2025. But I mean, just as a preview, we actually, I think there were a few sectors that I mentioned. For example, there was a question on the industrials. And when we look at kind of what are the expectations for industrials and also healthcare, the current consensus is for these two sectors to actually deliver higher earnings growth than the market average and the S&P. In particular, we think that, I mean, industrials is actually still fairly priced. So if you look at the PE of industrials, I mean, they're actually still below the market average. And also, if you look at I mean, if you follow the Fed framework, I mean, obviously, Trump policies actually benefit in industrials. So industrial is still a sector that we prefer. On the healthcare side, I mean, we actually still overweight healthcare, but I think in that side we said we pare back some of the overweights, just because it's a more defensive sector, and also I think from a Trump policy perspective, it's less clear. However, if you look at valuation and growth, actually healthcare is also expected to deliver higher growth than the market, and also healthcare valuation is very, very reasonable right now. So I think all in all, I mean, we actually have overweights in both of these sectors. Where we're less kind of, I guess, less positive on are some of the consumer sectors, because number one, the potential kind of restriction on labor market is going to pose much more challenges for these sectors. And also these are sectors that are a lot less likely to benefit from AI development. I think there were some questions on gold.
Yes.
I think under an inflationary regime, we would still have allocations to gold. We don't have a over allocation because the market is still quite supportive. So if you think about kind of gold versus risky assets, we still prefer risky assets like equity, but we also need to have some gold to balance out the risk. So that's a way to think about it. Over the long term, I mean, we're positive on growth on gold, even though it does not return it doesn't generate any income. We think it's a good alternative to US dollar. If you think back to kind of our framework of more fiscal burden for the US currency and also for other governments, we think that, I mean, gold is the only currency that is still for sure limited in supply. So in terms of having an alternative to other fiat currencies, we think gold actually provides a very good alternative.
Thank you, Stephanie. Couple of things. One is you might want to go back to the slide with the QR code.
Yes.
Exactly. So if people want to
Yes, good.
Kind of use the code. They know how to do that. There is a question that I want to answer very quickly. So somebody replied, so maybe it's better to time the market to enter instead of time in the market. And I want to say this is the opposite of what we wanted to say. So do not even try to time the market. It's impossible to time corrections. It's impossible to time bear markets. In your 30 years investment career, you're going to go through 5, 6 bear markets and 20 corrections or more. You can't avoid them. Just prepare for them and go through them and use them. That's, I guess, what we were trying to say. So maximize time in the market. Don't try to time the market. I guess that's the synthesis of that. Now, also, I'm receiving more questions that we are answering, meaning that every time we answer one question, I get 3 more. So either we stay here at infinitum, or we're never going to be able to answer all of them. So I'll ask for forgiveness in advance. I'm not going to be able to go through all of them, but we do still have a bit of time to go through some of them. So we talked about equities, we talked about sector. There's a few questions about countries, again, on the equity side, and then I'll move on to bonds. So it's going to be difficult to find the exact question, but I wrote down some of the synthesis. So there was somebody asking about India and Japan, because you mentioned them earlier, and say, hey, but this, I'm trying to find the verbatim, but I can't find it right now. Anyway, it was saying India and Japan have actually suffered recently. Why? Actually, here it is. ERA favors India and Japan, but both have been correcting lately. Please elaborate on your choice. This is one. There's a question on China. Will China markets be a concern given the increased uncertainty with Trump now back in office? And then there is a question of Europe saying, hey, but Europe is significantly cheaper than the US. Why do you not look at that?
Okay, so I guess from let me just tackle them one by one. In terms of Japan and India, yes, indeed, I mean, they have been weaker as of late, but for different reasons. I think if we look at Japan, I mean, of course, it had enjoyed a very impressive run, I guess, in the last 2 years. And in the last 6 months to 9 months or so, it had relatively lagged. Part of that is because of positioning. So a lot of investor money have flowed into Japan. And also part of that is because of the strength of the currency versus US dollar. Of course, I mean, the Japanese yen have reversed course and become weaker versus the US dollar. Therefore, I mean, the Japanese equity performance have actually been better as of late. What we actually see in Japan, or the bull case for Japan, is actually much more long term. In terms of the kind of, I guess, from a framework perspective, if you think about inflation, Japan is the only nation or the only country market that actually welcomes inflation. Actually, they need inflation. And if you think about the ERA framework of inflation staying higher for longer, that actually benefits Japanese corporates and equity markets much more than other countries. So, I mean, if Japan has gone through a deflation for the last 30 years, and 2024 was the first year that, number one, they have declared a kind of, I guess the BOJ have started raising interest rates, and number two, that the Nikkei has finally made a new high compared to 30 years ago. And we think this is actually a very, very, very important structural change for Japan. Not to mention, of course, the Japanese companies are going through a lot of corporate restructuring. You're seeing foreign investors, of course, Warren Buffett being one of the first one to go into Japan. We've also seen a lot of activist investors going into Japan as well. So we think that, I mean, Japanese equity is actually a very vibrant story that is not just a few months phenomenon, but it's much more longer term. So I think in terms of where we are in the cycle and also structural story for Japan, I mean, that still stands. In terms of India, I think also there's been a bit of rotation out of India into China. So if you look at Chinese equities, I mean, we've shown a chart in Chinese equities last year. It was up actually 20%, and there were a lot of kind of fund flows into Chinese equities at the expense of India. Now, so far, I think if you look at valuation for Chinese equities, I mean, that has returned to a historical normal range. So that re-rating from super, super cheap has been done already. And for Chinese equity to continue its bull market, we think that earnings actually needs to come through, and that's much harder. So we think last year, a lot of that kind of money that came into China actually came from India. Now, of course, India valuation was a bit more expensive as well. But today, I mean, with kind of the rotation and the correction, I mean, Indian valuation is a lot more reasonable. Secondly, if you track kind of the Indian earnings growth and also some of the leading indicators for example, PMIs for India, I mean, they have been consistently showing the highest growth globally in sort of these major markets that we can invest in. So India, we still see a good kind of case for growth, and I think that is also one of the reasons why ERAA maintained a overweight to the country. Of course, India is part of emerging markets. So when US dollar strengthens, I mean, that typically is not a great environment for emerging markets. And I think that's a bit of what's been happening in the last few months as well. Turning to Europe, yes, indeed. I mean, European equities have been are cheap versus the US. However, valuation is never a very good reason for going overweight or over allocating to a certain country. In fact, I mean, what we found is that countries or markets that are cheap can stay cheap for a long time if there's no catalyst, if there's no earnings recovery. And I think when we kind of look at the current economic situation in Europe, is actually in much worse shape than the US. For example, if you look at where AI technologies are changing, are benefiting corporates, I mean, they're much more pronounced and obvious in the US than in Europe. So that's why still, I mean, I think in terms of earnings delivery, US corporates can still deliver higher earnings growth than Europe.
Thank you. I have a super quick question, and then I'm going to turn into bonds. The super quick is, what is the conservative expectation on our returns? Could it be better than banks' time deposit? Maybe I'll take it quickly. Say, look, time deposit or banks' fixed deposits are cash from a asset perspective. So while in the short term they might overperform other asset classes because in the short term other asset classes might move more, in the long term they will underperform most of the other assets. So for your retirement plan, fixed deposit are probably not the right instrument unless you are extremely risk averse, and therefore you cannot go to sleep unless you know that whatever you're investing in has a guaranteed return and you can see it kind of accumulating every day. So our recommendation, while we offer a fixed deposit product in Singapore called Simple Guaranteed, our recommendation is always that for your longer term goals, retirement, for example, you might need to take a little bit more risk. Again, by thinking about what is the right risk for you. So I can't give individual advice right now, obviously, because I don't know who I'm speaking to directly, but this is something that you can assess as you use the platform, as you use the app. Make sure you take the right level of risk, but for your long-term goals, you might need to take a bit more risk. There is a risk in not taking enough risk. I know this sounds weird, but I guess that's a good way to think about it. Anything to add to this, Stephanie, or to say differently?
No, I think that's right? I think if you have a long time horizon to invest, and you're not taking enough risk for that long time horizon, basically you're missing out on a lot of potential returns. And I mean that is a risk as well, right? So risk is not always about drawdowns or mark to markets. It's also about kind of what are the potential returns that you're missing.
Perfect. Yeah. Moving on, bonds. There is 3 questions clubbed under this category. And guys, I've just seen there is like 5 or 6 new questions that came in. It's impossible. I'm not gonna go through them. So we have another maybe 5 minutes, and then I'll need to let Stephanie go. So stay with me for another 5 minutes. First, with long-term, it's actually not long. With 10 years government bond yield expect to remain high, above 5%. Will this not imply expectation of economic downturn going forward, which could mean that the Fed might need to increase number of rate cuts to support the economy? So this is more of an economy question, but kind of related to bonds. The second question is, with long-term bond yield likely to remain high, given the huge debt of the US, will this not be a good time to invest in long-term bonds ETFs versus short-term bond ETF? And so, duration question. And lastly, if I can find it, you are underweight bonds, but want bonds be acting as a good diversification to equities.
Yes. So maybe I'll answer the questions like by order. So the first question is about bonds. I kind of potentially, I mean, hitting 5% or kind of even going beyond, would that actually impact economic growth and drive recession? So typically, I mean, of course, when we see a recession, I mean, some of that is due to kind of very, very tight monetary policy when the central bank actually increased interest rates very aggressively, that slows down the economy. But more importantly, I think there's always kind of systemic risk in the system. So if you think about these risks, right? Basically, the Great Financial Crisis was the real estate bubble, and high interest rate actually filter through the real estate, and of course that triggered a lot of risk in the banking system as well. And then also, I think in COVID, I mean, there was a very, very short recession. It wasn't a traditional recession, but the economy has actually been slowing down already for quite some time before COVID hit. And therefore, I mean, that triggered also a very, very short recession. But always, I mean, basically, before you start to see a recession, I mean, there are kind of pockets of the economy that are big, but they are kind of vulnerable to like either the economic slowdown or a dry up in terms of liquidity. Today, I mean, we don't see a kind of I guess these kind of bigger pockets of risk. Of course, we've also gone through in I guess early 2023 Silicon Valley Bank, right? So the Silicon Valley Bank episode was actually caused by again U.S. Treasuries reaching a very high interest rate level, and when bond yields actually go up, bond prices actually have to be marked down. So the assets for these banks had to be written off, and therefore it triggered like the Silicon Valley Bank episode. However, what we've learned is also the Fed was very, very quick to come out and provide liquidity and to ensure that didn't spiral into a much bigger recession for the US. So we think that actually policymakers have been learning from these lessons, and they are very, very quick to react and prevented a kind of a spiraling out of, I guess, situation. So what we think is going to happen, if you think about US Treasuries actually hitting 5%, there are a few factors. Number one is, of course, like the fiscal deficit that we talk about, but that's very, very long term. I mean, this is something for us to kind of keep in mind for the next 10 years. But more importantly is because the US economy is actually strong. So if you look at the recent data that's coming out on labor markets, whenever there's strong data, US Treasury yields actually increase. So the reason for these interest rate increases or yield increases is because of strong labor market, and that indicates a lower risk of recession rather than vice versa. So I think it's a bit of it's actually the reverse. A stronger economy actually causes interest rates to go higher. And very, very naturally, I mean, that makes sense, right? In a stronger economy, you want to put your money into risky assets. You want to put your money in equities, and you don't want to put your money into bonds. And higher interest rate means that bonds actually suffer. So that sort of makes sense. I think in terms of, I guess, the second question, I guess, regarding having bonds in diversified portfolio, right? If I remember correctly, even though we're underweight, there is still allocations to bonds in a medium risk SRI portfolio. The reason is because, I mean, still it gives you some return, right? And in a kind of medium risk portfolio, if there is, although we don't see a chance of recession, if there is any chance of increased kind of economic slowdown, I mean, bonds still provide some protection. And also, I think more importantly, in all StashAway portfolios, we've actually maintained a lower duration, meaning that we're overweighting to some of the very, very short duration bonds that gets less affected by these changes in long duration interest rates. So that's why, I mean, still we have these bond allocations in our globally diversified portfolios. And then lastly, the question about whether or not you choose the lower duration or the shorter dated bonds versus the longer dated bonds. I think the answer was actually a very, very obvious 12 months ago, because 12 months ago, long dated bonds actually don't give you extra returns. I mean, that things have actually changed because the Fed lowered interest rates while the longer dated interest rates are staying higher, which means that actually today you get some extra return from going longer duration. So the question is it worth it, right? Is it worth for you to take on the extra risk for going longer duration? And I think that has to do with the income requirement for a particular individual investor. So if you take a step back, where you invest in bonds, where you invest in fixed income, The reason why it's called fixed income is because you're investing for a fixed coupon rate or a fixed payout on a regular basis. So, for example, if you invest in 10-year US Treasury, today let's say it's yielding 4.7%. That means that you're lending money to the US government for the next 10 years to get a 4.7% return per annum. And of course, during the course of the 10-year, the bond prices fluctuate, so your mark-to-market fluctuates. But at the end of the day, what you're targeting is actually the income. So that income doesn't change, right? It'll give you 4.7% coupon. And I think that's important because you need to ask yourself, is that 4.7% enough to cover my cost of living, to cover like my expenses? Am I happy to be able to receive that income for the next 10 years? I mean, if your answer is yes, then yes. I mean, I think that would be a better investment than a short-dated because you don't get that guarantee for the next 10 years. But if it's not enough, if you think inflation is going to be much higher, if it's not enough to cover your daily expenses, then I mean, maybe there are other better investments out there. So, for example, we have other bond asset classes like emerging markets or even corporate bonds, or as Michele mentioned, we have some alternative like private investments that offer higher, I guess, fixed income returns. I mean, those may be what you should be considering. But it's always consider the amount of fixed income that you like to receive for what time frame that you're investing for.
We're going to do two more questions, I promise. One should be a very quick one, and one, I guess, a bit longer. So let me start with a quick one. Siddhartha is asking, is it possible to get exposure to artificial intelligence through your thematic or flexible portfolios?
Yes. So within our thematic portfolios, we have one of them is called Technology Enabler. And in Technology Enabler, we do have a sub-theme that is exposed to artificial intelligence. So, I mean, that is one way to get exposure. I think that particular ETF is also available on Flex. So if you want to get a more direct exposure, I mean, that is where you can get, I guess, the allocation to that particular ETF.
Perfect. Last question. Michael is asking, there was a recent newspaper article stating expectation that Singapore MAS might pivot this year and let the US dollar grow stronger versus the Singapore dollars. How will that affect our portfolio since most equities are denominated in US dollars? I think you speak about kind of a base currencies versus actual exposure.
Yeah, I think if you look at our portfolios, even though they're denominated in US dollar, if you look at the underlying exposure, actually they're not 100% exposed to US dollar. Indeed, we have a neutral allocation of about 50 to 60% to US equities and US bonds, but the rest is actually well globally diversified among all the other major kind of markets and economies, including Euro, including Japanese yen, including, of course, like when we invest in India, that's Indian rupee. So it's important to, I think, kind of separate what is the denominating currency. Of course, like when an ETF is listed in the US, it trades in US dollar. But ultimately, when you're investing in an ETF, you get the benefit of the revenues and the earnings of the underlying companies that are not necessarily US companies. And even if you look at the S&P 500, actually a significant proportion of the S&P 500 actually gets their revenue overseas. So those are also not US dollars. So I think simplistically, yes, we are US dollar denominated, but in reality, it's much more diversified than that.
Perfect. Look, Stephanie, thank you so much. I know I went half an hour long, but
glad to see like lots of questions.
Actually, I could go on for another few hours, but I think it might be a bit too much also for people listening. But thank you. Thanks to everyone that has been listening, and actually most people are still connected, which is great to see. This is an important topic. If you have any, there were a few StashAway specific questions which I didn't get to. You can actually write into support at StashAway, and somebody will respond. Our colleagues will respond. Thanks a lot also to our colleagues that have been in the back responding to some of the more kind of tactical questions. I appreciate the work behind the scenes. So yeah, look, Happy New Year to everyone. We're going to have more and more engagement over the next few weeks and months. We'll keep some of these webinars and in-person seminars and meetings across all of the 5 countries. And I'm looking forward to meeting some of you in person. Thanks a lot once again, Stephanie. Thank you again, and have a good night, everyone.
Thank you everyone for being with us, and I mean we'll keep you all engaged throughout the year. So yeah, we'll be with you. And
Thank
thanks,
you.
Michele, for hosting as well. And have a good night, everyone.
Thanks a lot.